And Stevenson-Yang, co-founder of J Capital Research and author, mentioned that since China's economy is set to collapse, the rest of the world should be better prepared for deflation. As inflation soars globally and Xi Jinping's Communist Party continues to advocate for a zero-COVID policy, China has seen its exports collapse, bringing down the cost of commodities. 2020 and 2021 saw 2 years of extremely rapid economic expansion, but now China's export market is in perilous decline. Ms. Stevenson-Yang stated in a statement to ABC News, "So my base case for China, I think that the Chinese economy is really going through a crash. I think that China is going to spew deflation into the world pretty soon, like along about the third quarter of this year. If you want to understand what's going on in the second largest economy, watch this video." Continued real estate recession. Once more, experts in the West are warning that China's economy will fall. A debt bomb is set to erupt, according to one expert, while China is floundering, according to another. The government's zero-COVID policy, which places areas of the nation under constant lockdown, will cause the property bubble to bust. There will be too much debt and the economy will deteriorate. Additionally, there are the U.S.-imposed and ostensibly supported by its allies in Asia rising limitations on China's exports and investments overseas. The year of 2021 was difficult for China's real estate developers as a result of tighter financial regulations, which caused some of them, most notably Evergrande, to default on certain loan obligations. Growth in commercial sales and real estate investment has halted. Financial health in this industry will remain to be hampered by debt among real estate developers. The real estate crisis has gotten out of hand. The second largest private property developer in China, Evergrande, was on the verge of bankruptcy last year. In essence, Evergrande real estate model is in a Ponzi scheme. The company raises money through the pre-sale of an increasing number of apartments, as well as from hundreds of thousands of individual investors, and then uses the money to fund additional sales by speeding up ongoing construction and funding down payments. This operates like any Ponzi as long as it's escalating. However, when the market declines, those inflows of cash begin to lag behind the escalating curve of cash demands. There are now 800 incomplete projects at Evergrande, and 1.2 million individuals are on the standby list. Countless Chinese buyers have avoided making their initial mortgage payments as a result of the current real estate crisis. The fast-expanding mortgage payment boycotts by Chinese homebuyers have hit at least 301 projects and 91 localities, with an estimated 2 trillion yuan, $297 billion in mortgages at risk. Real estate accounts for over 70% of Chinese family wealth. In response, some Chinese banks have confiscated customers' savings accounts on the pretext that they're actually mortgage investment goods. This led to the government encircling the banks with tanks, when there were loud protests outside several banks. The urgency to encourage the creation of affordable homes and modify the commercial housing sector to better suit customers' housing demands was brought forth during the Economic Work Conference. Consumers' primary investment avenue is represented by this sector, and local government initiatives immediately bolster decreasing housing prices. The government makes an effort to solve this issue by supporting the building of affordable housing. At the same time, customers frequently encounter difficulties while trying to buy new homes owing to the increased pricing. The scale to which debt failures will affect both domestic investors and the rest of the financial sector is the key question underlying China's real estate collapse. The central bank decreased the loan prime rate and reserve requirement ratio in December in an attempt to encourage bank lending to eligible consumers. The administration has hinted that it is prepared to relax financial requirements to some level in order to lessen repercussions. While this is going on, it is doubtful that the government will directly assist indebted developers, instead opting to employ financial instruments to relieve the ensuing credit crunch. The government has also urged banks to assist sound developers in purchasing the projects of the troubled developers. Inflation. Without significantly affecting consumer price inflation, producer price inflation raised costs in 2021. This was brought on by high commodity prices, congested transportation, a lack of workers, and high energy costs. The second largest economy in the world was already struggling with rising energy and raw material prices when COVID lockdowns further hampered business operations. Due to the effect COVID limits have on a customer demand, it has also become more difficult for businesses to pass on the increased pricing to customers. This has resulted in a further decline in employment. Supply chain delays are predicted to persist in some degree into 2022 before decreasing by the second part of the year as COVID-19 related outages and rising demand normalize. Additionally, China will restore its power shortages caused by pollution regulations in 2022. and manufacturing schedules are probably going to change as well. There has been a minor increase in consumer price inflation as a consequence of producers starting to pass along greater costs to consumers. The Consumer Price Index has increased as a result of somewhat rising food prices. It is anticipated that a greater consumer price index in January would be partially caused by increased demand ahead of the Chinese New Year. Additionally, it is anticipated that China will experience an increase in import costs as a result of inflation in the United States and the European Union. Following Xi's crackdown in Hong Kong, one was implemented on the mainland that targeted big tech, beginning in late 2020 with Jack Ma, the founder of the Alibaba Group. As a result, equities in Shanghai fell. The situation is made worse by declining retail sales in China and new supply chain hiccups brought on by zero COVID, which are further obscuring the prospects for corporate profits. Mutual prosperity. Xi Jinping has persisted in emphasizing the value of shared prosperity, which entails fostering higher quality and more equitable economic growth. Additionally, in 2021, China enacted a number of rules, some of which targeted monopolistic businesses and their anti-consumer activities. In an effort to lessen economic disparity before any government rules, the campaign has already persuaded affluent people and businesses to make charitable contributions. Through 2022, the push for shared prosperity will intensify, albeit it's yet unclear how it will manifest in particular policies. More laws and policies to lessen inequality as well as exaggerated and unfair economic benefits may be implemented. Slowing economic growth. Economic stability is a top priority for the Chinese government for 2022. After the Central Economic Work Conference, Han Wenxiu, Deputy Director of the Office of the Central Committee of Finance and Economics, said that authorities should exercise caution when implementing policies that have a restricting impact on the economy. China's projected growth rate until 2022 has been set by the World Bank at 5.1%, which is much less than the country's historical average. China will probably increase its fixed asset investment to support its GDP. Investing in infrastructure will make up a sizable portion of this. In order to partially finance fiscal expenditures, the nation will likely continue to release special bonds. But hold on a second. What are the root reasons of the present real estate crisis and debt growth? It may be directly attributed to China's growing private sector, which has been supported by a significant portion of the Chinese leadership, especially in the banking and real estate industries. China's investment growth is increasingly concentrated on unproductive industries like banking and real estate. Why was home construction in China, of all nations, entrusted to private capital developers who offered mortgages to buy? Why weren't houses constructed by the government sector for rent? As a consequence, the state is now faced with cleaning up a typical example of a Western real estate market meltdown. It is up to the state-local government to deal with this. There won't be a Chinese financial crisis. That's because the government holds sway over the financial levers of control, including the central bank. The 4 largest state-owned commercial banks in the world, the so-called bad banks that take on bad loans, huge assessment managers, and the majority of the largest corporations. The government has the authority to require the top 4 banks to forgive defaulted debts in return for ownership holdings. It can instruct China's central bank, the People's Bank of China, to undertake whatever action is necessary. It can instruct pension funds and state-owned asset managers to purchase stocks and bonds to support market prices and finance businesses. But the present real estate disaster is a warning that the profit-based sector's turmoil and irrationality are having a greater impact on the Chinese economy. The private sector has struggled both during and after COVID. Just one little example, COVID lockdowns were sold to the private sector in Shanghai with dismal outcomes, while they were handled directly by the local government in Beijing with far better outcomes. China requires overturning the growth of the private sector and starting introducing more efficient strategies for state investment, but this time with the democratic participation of the Chinese people in the process, and not by tanks out beyond banks. Far from being the solution to China's mini-crisis, demanding more liberalizing economic reforms toward capitalism. Instead, the leadership's goals for shared prosperity will just be rhetoric.